The number one takeaway from the investment composition by different wealth levels. There's a marked difference in assets at different wealth levels. Based on data from the Survey of Consumer Finances and a 2017 research paper by Edward N. Wolf, an American economist who focused on wealth and wealth disparity, we can glean some insight into how individuals in different wealth levels, net worth levels, invest their money. And let me tell you after studying this data, where a person with a $500,000 net worth invests their money in is vastly different from where a person with $10 million in net worth invests their money into. And in today's video, we're going to delve into how they're different, why they might be, and what are some key takeaways we can apply to our own personal lives. But first, let's take a look at the data because it's quite interesting. We're going to break down the wealth levels into three groups. The first group with net worth between $0 and $500,000. The second group between $500,000 and $10 million. And the third group, essentially the ultra rich, 10 million plus club. And we're going to break down the assets that they're invested into 6 different categories. 1. Principal residence. 2. Pension accounts. 3. Liquid assets. 4. Miscellaneous assets. 5. Stocks, securities, mutual funds. And 6. Business equity and other real estate. Alright, so how do each wealth group invest their money across these 6 categories? Starting with the $0 to $500,000 group. In general, the middle class group. Principal residence, 62%. Pension accounts, almost 17%. Liquid assets, 8.5%. Miscellaneous assets, 1.2%. Stock, securities, mutual funds, almost 4%. Business equity and other real estate, almost 8%. Next, the $500,000 to $10 million wealth group. I would say the relatively wealthy. Principal residence, 26%. Pension accounts, 22%. Liquid assets, 8%. Miscellaneous assets, 1.2%. Stock, security, mutual funds, 18.5%. Business equity and other real estate, 24.5%. And finally, the 10 million plus wealth group. In this context, the ultra wealthy. Principal residence, 7.6%. Pension account, 6%. Liquid assets, 7%. Miscellaneous assets, 1.4%. Stock, securities, mutual funds, 31.4%. Business equity and other real estate, 49%. In general, you can see a marked difference in how the middle class families invest their money relative to the wealthier group. One of the first things that pop out is a concentration of assets in their primary residence, which leads to the next takeaway. The number 2 takeaway. The lower the wealth level, heavier reliance on primary residence as a good percentage of one's overall net worth. That really is one of the first things that pop out when we look at the data. Households in the $0 to $500,000 wealth distribution hold most of their wealth in primary residence. More than half their wealth, 62%, is within their primary residence. And that is quite a bit. And my speculation is that most often, this is not by design. Most often, it became this way by default. Many people buy homes and pay their mortgage for decades without thinking much about it, because if they don't, they'll be on the street. And if they didn't invest in other assets, by the time they're ready to retire, it turns out that their home is really their only wealth. Some reports show how 30% of American households have no wealth outside of their primary residence. Now, when we start moving up the wealth ladder, we start to see that principal residence start to make up a smaller and smaller portion of one's overall wealth. 26% for the $500,000 to $10 million group, and around 8% for the 10 million plus group. And this trend makes sense. The higher net worth individuals were able to grow their overall wealth because they started investing money in other assets apart from their primary residence. Stocks, security, business interests, and even other real estate. Which leads to the next takeaway. However, before we get there, in talking about net worth, are you curious to know where you stand? If you were to add up all your various accounts, where your wealth level is? Well, what if I was to tell you there's a simple tool that you can use to see all your accounts in one place? Which is why I'm excited to talk to you about Empower, who I'm partnering with for today's video. With anything in life, if we want to make good decisions, it starts with good information. Accurate information. Thus, if we want to make good personal finance investing decisions, we must first ensure we understand where we stand with our finances. Well, this is where Empower can help with their free personal dashboard. Once you connect your accounts, this beautiful dashboard allows you to see in one glance where you stand with your finances. Additionally, if you want to get a better understanding of all your investments, Empower's investment checkup tool helps you see your complete portfolio asset allocation in one page. Its retirement fee analyzer also allows you to see how much you're paying in fees across all your accounts. Remember, every dollar you pay in fees is a dollar that is now compounding and growing. And all these functionalities and more are completely free when you sign up. So if you want to get a better handle of your finances, better understanding of where you stand, I highly recommend you check out Empower today. Please go to my special link I'll have in the description below to get started with their free dashboard. Again, the link in the description below. Alright, with that said, let's get back to the video. The number 3 takeaway from the investment composition by different wealth levels. There's a huge disparity in stock market participation between the lower wealth and higher wealth group. To represent the stock market participation, we'll add the stock, securities, and mutual fund category and the pension category, which includes IRAs, 401ks, and other retirement accounts. For the $0 to $500,000 wealth group, we're looking at 20% of their overall net worth made up by the stock market. Not bad, but relatively small given how much their primary residence take up. Now, when we move to the $500,000 to $10 million group, the stock market participation pretty much doubles. When we add up the pension accounts and the stock, securities, and mutual funds, they total 41%. Almost half this group's wealth. What can we conclude from this? That individuals within this wealth group rely heavily on the stock market for their wealth, for appreciation. Now, what gets really interesting is when we move to the ultra wealthy, the 10 million plus group, and see their stock market participation. Pension accounts and the stock, securities, and mutual funds combined, we get 37%. Still more than the $0 to $500,000 wealth group, but slightly less than the $500,000 to $10 million group. Interesting, right? The stock market participation increased dramatically from $0 to $500,000 wealth group to the $500,000 to the $10 million wealth group, but started to taper off and actually decline as we approach the 10 million plus group. Why might this be? Well, let's get into that next. The number 4 takeaway from the investment composition by different wealth levels. Many ultra wealthy, the 10 million plus group individuals are business owners. Of the people surveyed for this research paper by economist Edward Wolf, a stunning 2/3, 67% of the 10 million plus group reported owning their own business. The other two groups? Only 29% of those in the $500,000 to $10 million reported owning their own business, and 8% of those in the $0 to $500,000 reported owning their own business. And we can see this in the composition of net worth as well. Business, equity, and other real estate only make up 8% of those in the $0 to $500,000 wealth group. But this number jumps to 24.5% for the $500,000 to $10 million group, and jumped even more to 49% for the 10 million plus group. Tying it back to the earlier takeaway, one of the reasons why stock market represented a smaller pie of the overall net worth for the 10 million plus club versus the $500,000 to the 10 million club was because as one moved up the wealth ladder, they started to invest more into businesses and other real estate investments. This could be their own business or someone else's, investing for a percentage of equity. And if we were to take a step back, this makes sense. The fact that many ultra wealthy are business owners, and the fact that a good percentage of their wealth is represented by business interest. This is because no matter how well paying a 9-to-5 job is, there is often an income cap. Even the world's most talented surgeon will have an income cap, unless that individual ventures out to build something they have equity in, or is somehow able to gain greater leverage. And when there's a limit to how much you can make in income, there is a limit to how much you can invest and grow your wealth. To break the 10 million plus net worth ceiling as a salaried employee is possible, but it will take a lot of effort in earning, saving, investing, and most importantly, waiting. The number 5 takeaway from the investment composition by different wealth levels. Segueing from the earlier point, the ultra wealthy, the 10 million plus individuals, are very asset heavy. For the 10 million plus club, when we add up just the stocks, security, mutual funds, business equity, and other real estate categories, we get a whopping 80.4%. Compare that to the $500,000 to 10 million wealth group, who has 43% of their wealth invested in stocks, security, mutual funds, business, and other real estate. Or the $0 to $500,000 wealth group, less than 12%. What this disparity is showing is that as one moves up the wealth ladder, they're becoming more intentional and active about investing in assets. Now, some questions that might pop in our heads are these. Are they becoming wealthier because they're actively investing in assets? Or did they start to invest in assets once they became wealthier as a means for increased diversification and appreciation? The chicken or the egg question, right? The truth is probably a mix of both. The bottom line we can take away from this data is that regardless of what came first, the fact is that the ultra wealthy are very asset heavy, 80% heavy, which leads to the next takeaway. The number 6 takeaway from the investment composition by different wealth levels. With increased wealth comes increased risk tolerance. Another interesting data point that is not directly reflected by the numbers we reviewed so far, but is mentioned in the research paper referenced for this video, is the fact that in addition to inequality in the wealth levels, there is also inequality of rate of return when comparing different wealth groups. The individuals within the 10 million plus group earn consistently higher return on gross assets compared to the other groups. This was because they were investing in higher yielding investments like stocks and businesses. Those in the 0 to half million net worth group, especially those that were heavily reliant upon primary residence to make up their wealth, weren't able to garner higher returns because they weren't investing in other assets. All their money was tied up in their home, which historically had lower returns compared to stocks. To me, what this showed me was that those in the higher wealth group had a higher threshold for risk. They can take greater risk with a portion of their net worth, which has a chance of providing higher returns because they have room. The size of their net worth allows them to take healthy bets, which in turn has the effect of making them wealthier and wealthier. Yes, from a broader socioeconomic perspective, this shows why we have a growing wealth gap between the different wealth groups, the wealth disparity. However, if you're serious about building wealth to move up the wealth ladder, you must also get comfortable with taking risks. As we saw earlier, those in the 10 million plus club have 80% of their net worth invested in assets, ranging from the stock market, business interests, to real estate investments. That is risk. I'm sure most are smart about the type of risk they're taking, and also are well diversifying themselves so they're not dependent upon one type of asset, but the bottom line is that risk is a necessary component to building wealth. But before we go on, I want to share with you a free gift that could help you in your investing journey. Do you ever wonder what type of an investor you are? Are you more risk tolerant, or are you more conservative? Or maybe you're more open to the international market. Well, if you are, you're in luck, my friend. By answering just a few questions in this investor assessment quiz, you can receive a free customized investing plan. It will not only show you what type of investor you are, you'll also get a sample investing portfolio, plus tips to make sure you're staying on track to meet your investing goals. So make sure to go to the link I'll have in the description below to receive your free investing plan. Alright, with that said, let's get back to the video. Number 7 takeaway from the investment composition by different wealth levels. Regardless of the wealth level, cash is always king. Another interesting takeaway from this data was the percentage of liquid assets at the different wealth levels. Liquid assets include easily accessible accounts like checking, saving, or money market funds. While there were slight changes at the different wealth levels, nothing significant enough to stand out. For those in the 0 to half million wealth group, liquid assets made up 8.5% of their net worth. For those in the half million to 10 million wealth group, liquid assets made up 7.7% of their net worth. For those in the ultra wealthy, the 10 million plus wealth group, liquid assets made up 6.7% of their net worth. As you can see, there was a percentage change between the wealth groups, but not that significant. And to be honest, I was very surprised by this data point. I thought that once you got to a certain net worth level, the 10 million plus level, you would keep less in cash. I mean, if you have a net worth of $10 million, 6.7% of that is $670,000 in liquid cash. From a pure dollar amount perspective, that is a lot of money just sitting there, not invested in the market or other assets, not working and not appreciating. However, what this also showed me was that regardless of what net worth level you're at, cash always plays a significant role in your finances. For emotional security, or just having dry powder to snatch up assets at good value, cash is always king. The number 8 takeaway from the investment composition by different wealth levels. This is another interesting one. Regardless of the wealth level, miscellaneous assets remain a relatively small percentage of one's overall wealth. When we watch too many movies about the rich, it's easy to believe that the wealthy holds a good chunk of their assets in other miscellaneous and interesting assets, such as precious metal, jewelry, antiques, and even furs. However, when we look at the data, not so. For those in the 0 to half million wealth group, miscellaneous assets made up 1.2% of their net worth. For those in the half million to 10 million wealth group, miscellaneous assets made up again 1.2% of their net worth. For those in the ultra wealthy, the 10 million plus wealth group, miscellaneous assets made up only 1.4% of their net worth. A slight jump, and of course a jump in total dollar value, but we're still talking about 1% of their total wealth. So what to glean from this data point? Despite how much we hear about how the rich and the wealthy hold their money in these sexy and exotic assets, the reality is far from the truth. The ultra wealthy, the 10 million plus club, invest majority of their money in tried and true assets, such as the stock market, businesses, and real estate, not speculative assets. The number 9 takeaway from the investment composition by different wealth levels. Higher the wealth, the lower debt to wealth ratio. This is an interesting one because most people actually believe the opposite. You watch enough movies about the stock market and how the ultra rich got to where they're at, we come to believe that debt, leverage, other people's money was how they got there. And they're continually over leveraging themselves to a T to maximize their returns. However, the data tells a very different story. It is actually the opposite. Those in the lower wealth category actually have a higher percentage of debt relative to wealth. For those in the $0 to $500,000 wealth group, their debt to net worth ratio is 59%. Pretty highly leveraged. For those in the $500,000 to $10 million wealth group, their debt levels with debt to net worth ratio drops to 10.1%, a moderate level. But this is the most interesting. For those in the ultra wealthy, the 10 million plus wealth group, their debt to net worth ratio, whopping 2.4%. We're now in the low single digits. So it is not true that the ultra wealthy are continually borrowing. They're investing heavily in assets, but they're doing it with minimal debt as they get wealthier. The number 10 and final takeaway from the investment composition by different wealth levels. As our wealth grows, we should continually diversify. My guess is that most of you watching this video is likely in the 0 to half million or the half million to 10 million net worth club. And if you're like me, you aspire to one day join the 10 million plus net worth club. If so, this video should have highlighted some key things for you. For me, the biggest takeaway was the importance of diversification and risk, especially as our wealth grows. As we saw earlier, the ultra wealthy, those in the 10 million plus wealth club, are heavily invested in assets, and multiple types of assets at that. 80% of their money is invested not only in the stock market, but other real estate holdings and business interests. And rightly so, because apart from the stock market, these are other assets that can provide good, sometimes better than stock market returns. If done well, much better. So keep that in mind as you grow your wealth. While you want to use the stock market, primarily through low-cost, broad market index funds to build a core component of your wealth, as your wealth grows, you might want to look at branching out to other types of assets, real estate, or even starting your own business. Thank you guys for watching. In the theme of different types of investments, I recommend you check out my video here on the investment spectrum, where I delve deeper into different asset types and how they have performed in the past. Until next time, all the best.